Before we begin, please note that I am not a licensed financial advisor or insurance professional. The information provided in this video is for educational and informational purposes only and should not be considered as financial or legal advice. Insurance policies, regulations, and costs vary significantly by state, provider, and individual circumstances. You should always consult with a qualified and licensed insurance agent to determine the best coverage for your specific needs. You just brought it home. The silent, instant acceleration pins you to your seat. The massive screen feels like a command center from the future. You've got that famous Tesla smile plastered across your face. You've joined the electric revolution. And then the email arrives. The insurance quote. Suddenly that Tesla smile vanishes. Your jaw hits the floor. The number you're looking at is double, maybe triple what you paid for your last car. It feels like a penalty, a tax for daring to drive the future. You start doing the math, and that monthly premium looks more like a car payment for a second vehicle. For a shocking number of new owners, this is the moment the dream almost dies. The moment they ask themselves, can I even afford to keep this car? If that sounds even remotely familiar, you are in the right place. Because in the next few minutes, I'm going to pull back the curtain on the entire Tesla insurance industry. We're going to expose why your premiums are so outrageously high. And it's not just because the car is expensive. We're going to uncover the hidden risks and the secret discounts that most agents don't even know about. This isn't just another video with a few generic tips. This is the definitive guide every single Tesla owner in the United States needs to watch. By the end of this, you will not only understand the system, you will know how to make it work for you, potentially saving you thousands of dollars a year and giving you the one thing that's more important than any discount: peace of mind. So let's get right into it. The single biggest misunderstanding about insuring a Tesla is thinking it's just like insuring any other car. It's not. To a traditional insurance company, your beautiful high-tech machine isn't a car. It's a high-risk, high-cost, unpredictable black box on wheels. And their fear is costing you a fortune. We need to understand why they're so terrified. It boils down to one simple concept: repair costs. The first reason is the very thing that makes the car so strong and lightweight. It's aluminum construction. Most cars on the road are made primarily of steel. When you get a dent in a steel door, a good body shop can often pull that dent out, fill it, sand it, and paint it. It's a craft they've perfected over decades. But much of a Tesla's body is made from high-strength aluminum. You can't just pull a dent out of aluminum in the same way. It has no memory. It stretches and tears differently. More often than not, a damaged aluminum panel can't be repaired. It has to be completely replaced. This requires specialized equipment, specialized training, and a whole lot more labor. So a fender bender that would be a $1,500 fix on a Honda Accord can easily become a $7,000 panel replacement on a Model 3. To an insurer, that's a 5x multiplier on their potential payout for even the most minor cosmetic damage. The second reason is the technology that's literally embedded in every surface of the car. Take the windshield. On a normal car, a rock chip means a couple $100 for a new piece of glass. On a Tesla, the windshield is not just glass. It's the housing for the intricate camera suite that powers autopilot. When you replace that windshield, you're not just swapping glass. You're performing a delicate surgery that requires a painstaking multi-hour recalibration of those cameras. If it's not done perfectly, the car's most important safety features could fail. This process can only be done by technicians with specific, expensive tools. So your simple windshield replacement just went from $200 to over $1,500. Now apply that logic everywhere. That side mirror isn't just a mirror. It's a housing for a camera, a heater, and a motor. That front bumper isn't just plastic. It's a shield for multiple ultrasonic sensors and potentially a radar unit. A minor parking lot scuff isn't just a paint job. It's a potential sensor replacement and recalibration nightmare. For insurance companies who think in terms of actuarial tables and predictable costs, this is chaos. They see every single component as a high-tech, high-cost liability. But the third reason is the one that truly keeps insurance executives up at night. It's the battery. The battery pack in your Tesla is the single most expensive component of the vehicle by far. In newer models, it's not just a component. It's a structural part of the car's frame. This is brilliant for engineering, safety, and handling. It's a catastrophe for insurance. It means that an impact to the side of the car, or running over debris on the highway, doesn't just damage the body. It has the potential to damage the battery case itself. And here's the terrifying part for an insurer. In most cases, the high-voltage battery pack is not considered reparable. Any significant damage to the pack or its casing often means one thing: the entire battery has to be replaced. A battery replacement can cost $15,000, $20,000, even $25,000 or more. On a 4-year-old Model 3 that's worth, say, $30,000, a battery replacement is an instant total loss. The car is totaled. The insurance company has to write a check for the full value of your car. They are petrified of this scenario. They see a Tesla driving down the road and they don't see an eco-friendly Marvel. They see a $20,000 time bomb that could be triggered by a single pothole. And this all leads to the fourth and final factor that ties it all together: the repair network bottleneck. Because of all the specialized technology, the aluminum bodies, and the high-voltage batteries, you can't just take your Tesla to the local corner mechanic. You have to take it to a Tesla-approved body shop, and there are not nearly enough of them. In some entire states, you might only find a handful of certified repair centers. This creates a massive supply and demand problem. These certified shops can charge higher labor rates because they have a captive audience. More importantly, it creates huge backlogs for parts and service. It's not uncommon for a Tesla to be in the shop for months waiting for a simple repair. And while your car is sitting there, who do you think is paying for your rental car? Your insurance company. A 30-day rental can add thousands of dollars to the claim. A 3-month wait can add $10,000 to what was already an expensive claim. It's a death spiral of costs. So when you put it all together, the expensive aluminum that can't be easily fixed, the high-tech sensors embedded in every panel, the walking time bomb of the structural battery pack, and the bottleneck of a tiny, overwhelmed repair network, you start to see the picture. The insurance company isn't just giving you a high quote because they're greedy, though that's part of it. They're giving you a high quote because they are genuinely terrified of the unknown and astronomical costs associated with repairing your car. They're taking their worst-case scenario, adding a massive profit margin on top, and sending you the bill. They are pricing your policy not for the driver you are, but for the most expensive repair imaginable. But here's the secret: it doesn't have to be this way. Understanding their fear is the first step to conquering it. And now that we know why they're charging you so much, we can begin to systematically dismantle their arguments and find the coverage that protects you without bankrupting you. And the first place we're going to look is the one company that claims to have solved this problem: Tesla itself. Yes, on the surface it's the perfect pitch. Who knows a Tesla better than Tesla? Who has more data on how these cars are driven, where their weaknesses are, and what a safe driver actually looks like behind the wheel of a Model 3 or a Model Y? It's a compelling argument. They cut out the middleman, the legacy insurance company that still thinks your car has an engine and an oil pan. Instead, Tesla offers a direct-to-consumer product built on a single revolutionary idea. Your insurance premium should be based on how you actually drive, not on how a demographic spreadsheet says you might drive. This is all powered by their proprietary safety score. It's a number from 0 to 100 that Tesla calculates in real time based on your driving habits. It's a big brother in your dashboard, but a supposedly benevolent one. The higher your score, the lower your premium. Simple. Drive safe, save money. Drive like you're in a Fast and Furious movie and you'll pay for it. This isn't just a guess. It's a data-driven promise. The safety score watches 5 key things. First, forward collision warnings. This is how many times the car yells at you per 1,000 miles that you're about to hit something. Second, hard braking. This is defined as a decrease in the car's speed of more than 6.7 miles per hour in a single second. Third, aggressive turning. That's a left or right movement that the car's sensors feel is too quick, registering a force of over 0.4 G. Fourth, unsafe following distance. This measures the amount of time you spend tailgating, specifically when you're less than 3 seconds behind the car in front of you and traveling over 50 miles per hour. And fifth, a new one they added, forced autopilot disengagement. This is when you're on autopilot and you ignore the warnings to put your hands on the wheel 3 times, forcing the system to lock you out for the rest of the drive. Each of these behaviors is fed into a complex formula, and out pops your score. A 98, a 99, a perfect 100. It gamifies your daily commute. You start checking the app obsessively. You see your score dip from a 99 to a 98 after you had to slam on the brakes for a deer, and you feel a genuine pang of anxiety. You start driving not just to get to your destination, but to protect your score. You become a participant in Tesla's grand experiment. And this is where the beautiful data-driven dream starts to crack. Because the real world is not a simulation. The real world is messy, unpredictable, and doesn't care about your safety score. Let's take hard braking. In theory, Avoiding it is a sign of a good driver who anticipates traffic. In reality, it penalizes you for the mistakes of others. Someone cuts you off on the freeway and you have two choices: slam on the brakes and ruin your perfect score for the month, or maintain your speed and risk a collision. The system, in its cold algorithmic logic, punishes the correct, safe, defensive driving maneuver. I've heard from countless owners who have had their monthly premium spike because a child ran out into the street, and they had to stomp on the brake pedal to avoid a tragedy. The system doesn't see a hero, it sees a data point. It sees a minus 6.7 miles per hour per second deceleration, and flags you as a risky driver. Or how about unsafe following distance? The system tracks the time between you and the car in front. But what happens in the dense, stop-and-go traffic of Los Angeles, or Chicago, or Atlanta? If you leave a responsible 3-second gap, I can guarantee you what happens next. Two other cars will immediately fill it. So you're forced to choose between tailgating to prevent people from cutting in, or constantly backing off and letting everyone merge, turning a 30-minute commute into an hour-long ordeal. The safety score doesn't understand the unwritten rules and aggressive nature of American city driving. It was designed in a lab, not on the 405 at rush hour. And the forward collision warnings. Oh, the phantom braking. Every Tesla owner knows what I'm talking about. You're driving on a perfectly clear road, autopilot engaged, and the car suddenly violently slams on the brakes for a shadow, a bridge overpass, or a plastic bag blowing in the wind. The car screams at you with a collision warning for a threat that never existed. Not only is it terrifying, but it dings your safety score. The car's own flaw is used as evidence against you to charge you more money. It's a level of corporate gaslighting that is truly next level. So you adapt. You learn to play the game. You start rolling through stop signs to avoid the G-forces of a hard stop. You hesitate to brake for yellow lights. You let your following distance grow so large that you become a rolling roadblock, angering everyone behind you. You are actively, consciously driving in a less natural, and sometimes less safe way, all to please the algorithm in the sky. You're no longer driving to be safe. You're driving to get a high score. And those are two very different things. But let's say you master the game. You are a Zen master of gentle acceleration and telepathic braking. You achieve a score of 99 or 100. You are rewarded with a potentially very low premium for 1 month. Because unlike traditional insurance where your rate is locked in for 6 or 12 months, Tesla Insurance can, and does, change your premium every single month based on your score. Think about that. You could have a perfect record for 30 days. A premium of, say, $120. Then, on the 31st day you have a bad trip. You get cut off twice, the car phantom brakes on the highway, and you have to make an aggressive turn to avoid a pothole. Your score for that day plummets. And suddenly, your bill for the next month jumps to $190, or $250, or even more. That financial stability that insurance is supposed to provide? It's gone. Replaced by a monthly lottery based on how lucky you were on the road. And what if you have a legitimate dispute? What if you know for a fact that a heartbreaking event was the car's fault? Or that a collision warning was a phantom alert? There is no one to call. There is no appeals process. You cannot present dashcam footage to a human underwriter and say, "Look, this wasn't my fault." The data is the data. The score is the score. The verdict is final, and it's rendered by a machine that sees you not as a person, but as a collection of inputs. Then there's the final piece of the puzzle. What happens when you actually need them? When you get into an accident? The promise is a seamless experience. Tesla knows the car, they have the parts, they have the service centers. The reality for many has been a nightmare. The claims process is often outsourced to third-party adjusters who are just as overwhelmed and unfamiliar with Teslas as any other insurance company. Owners report waiting weeks for an initial response, months for repair approvals, and being forced into battles over using genuine Tesla parts versus aftermarket ones. The streamlined, futuristic experience they were sold on the front end evaporates, replaced by the same old bureaucratic, soul-crushing insurance experience they were trying to escape. Now, to be fair, Tesla insurance is not available in every state. As of right now, it's only in about a dozen states, including Arizona, California, Texas, and Ohio. So for most of the country, this is a purely academic discussion. And for some drivers in those states, people with near-perfect driving habits, who live in low-traffic areas and are willing to accept the monthly price volatility, it can legitimately be the cheapest option, sometimes by a significant margin. But it's a gamble. You're betting that the algorithm will be fair. You're betting that other drivers won't force you into a bad score. You're betting that the car's own quirks won't be used against you. And you're betting that if the worst happens, the company that sold you a futuristic dream will actually show up to help you clean up the mess. For many, that's a bet that has soured the entire ownership experience. The very company they trusted to build their car is now penalizing them for driving it in the real world. So if the company that makes the car can't even get it right, what hope do the old-school legacy insurers have? How does a company like State Farm or Geico even begin to understand a vehicle that's more like a rolling computer than a car? Well, their approach is completely different. They don't see a driver, they see a statistic. And the statistics they're seeing are starting to scare them to death. And what they see when they look at a Tesla isn't a marvel of engineering. It's a black hole for money. To understand why your premium is skyrocketing, you have to put on the glasses of an insurance actuary. You have to see the car not as a driver, but as a collection of risk factors. And for them, nearly every single thing that makes a Tesla is a giant flashing red light. Let's start with the most obvious one, the cost of repairs. This is the single biggest driver of high insurance rates. And it's a problem that goes far deeper than most owners realize. You might think a fender bender is a fender bender, right? A few $100 for a new bumper, maybe $1,000 for some paint and labor. Not in a Tesla. That same minor collision, the kind of thing you barely notice on a Honda Civic, can easily turn into a 5-figure repair bill. We're talking $10, $15, even $20,000 for what looks like cosmetic damage. Why? Because a Tesla isn't built like a normal car. The body isn't just stamped steel. It's a complex mix of aluminum and high-strength steel, bonded and welded in ways that are fantastic for safety and performance, but a nightmare for repairs. You can't just pull out a dent. Often, entire massive sections of the car need to be replaced. The front fender isn't just a fender. It's tied into the A-pillar and the entire unibody structure. A hit there can compromise the integrity of the whole frame. And then there are the sensors. Your average new car has a few parking sensors. A Tesla is a rolling sensor suite. There are cameras in the windshield, the pillars, the fenders, the rear. There are ultrasonic sensors ringing the entire vehicle. There's radar hidden behind the front bumper. Now imagine that low-speed parking lot bump again. You haven't just damaged a piece of plastic. You've potentially destroyed a sophisticated camera, misaligned a critical radar unit, or damaged the wiring harness that connects it all to the car's central computer. Replacing that bumper now involves not just paint and plastic, but delicate electronics, specialized tools, and hours of calibration to make sure autopilot and the safety systems still work correctly. That's not a body shop job. That's a high-tech electronics repair job that costs a fortune. But the real terror for an insurance company, the thing that keeps them up at night, is what lies beneath the floor. The battery pack. The entire structural heart of the vehicle is a massive skateboard-like battery that runs the length of the car. It's incredibly well protected, but if it is compromised in an accident, even with what looks like minor undercarriage damage from running over road debris, the consequences are catastrophic. Repairing a damaged battery pack is often not an option. It's a full replacement. We're talking about a single part that can cost upwards of $20,000 to $25,000 before you even factor in the specialized labor to install it. This has led to the now infamous phenomenon of Teslas being totaled for what appears to be minor damage. You've seen the stories online. A Model Y gets rear-ended at a stoplight. The bumper is cracked, the liftgate is dented, but it drives away fine. The owner takes it to a certified repair shop and gets the estimate, $30,000. The insurance company looks at that number, compares it to the current market value of the car, and decides it's cheaper to just write the car off, give the owner a check, and sell the damaged vehicle for salvage. From the insurer's perspective, it's a simple business decision. But for the owner, it's a shocking realization that their high-tech car is also incredibly fragile from a financial standpoint. This problem is compounded by a second massive issue, the parts and labor bottleneck. Let's say your Tesla needs a new side repeater camera and a front quarter panel. You can't just go to your local Napa Auto Parts. You can't even go to most body shops. Tesla maintains incredibly tight control over its parts supply chain. And to work on these cars, especially for structural or electronics repairs, a shop needs to be Tesla certified. This certification process is expensive and rigorous, meaning there are far fewer certified shops than there are for, say, Ford or Toyota. What does this create? A classic case of low supply and high demand. These certified shops can charge a premium for their labor, because where else are you going to go? And because they're dealing with a backlog of cars, wait times for repairs can be astronomical. It's not uncommon to hear of owners waiting 3, 6, even 9 months for their car to be repaired after an accident. Now, think about that from the insurer's perspective again. Not only are they paying a massive bill for the repair itself, but they are also on the hook for your rental car for that entire period. If you have rental reimbursement on your policy, they could be paying $30, $40, or $50 a day for months on end. A 3-month wait for a repair could add another $4,000 to the total claim cost, all because of delays in the supply chain. Every single one of these dollars gets factored back into the risk profile for every Tesla on the road. They see a car that is not only expensive to fix, but takes an eternity to get back on the road, costing them money every single day it sits in the shop. But there's a third, more subtle factor at play here. It's a psychological one, driven by the very technology that makes the car so appealing. I'm talking about Sentry Mode. On any other car, if someone dings your door in a parking lot and drives away, you probably wouldn't even notice for days. And when you did, you'd likely just sigh and live with it. Filing a claim for a tiny dent isn't worth the hassle or the potential rate increase. With a Tesla, it's different. Sentry Mode records everything. You get back to your car, and there's a notification on the screen. Sentry event recorded. You review the footage and watch in crystal clear HD as someone carelessly swings their door into yours, looks around and drives off. Now you have evidence. You have their license plate. It's no longer an anonymous act of fate. It's a documented incident. You feel violated, and you are far, far more likely to file a police report and an insurance claim to get it fixed. The same goes for the giant glass roof. It's a stunning feature, but a rock kicked up by a truck on the highway, which might cause a small, easily reparable star on a normal windshield, can cause a massive crack in that panoramic roof. That's not a $100 Safelite repair. That's a $2,000 plus full roof panel replacement. So, from the cold, hard perspective of a legacy insurance company like Geico or Progressive, the picture is grim. They see a vehicle where minor accidents lead to major repair bills. They see a restricted parts and repair network that leads to insane delays and ballooning rental car costs. And they see a population of tech-savvy owners who use the car's own surveillance systems to file more claims for minor cosmetic damage than any other group of drivers. They aren't insuring a car. They are insuring a high-maintenance, high-cost, high-frequency claim supercomputer on wheels. And their old-world algorithms, the ones built on decades of data from gasoline-powered, steel-bodied cars, are throwing up red flags and sounding alarm bells. Their only defense, their only tool to mitigate this terrifying new risk, is to charge you, the owner, an astronomical premium. They're not punishing you. They're protecting themselves from a vehicle they simply do not understand and cannot accurately predict. This has created a massive opening, a vacuum in the market. If the old guard can't figure out how to insure these cars properly, who can? Well, the answer seems obvious. The company that makes the car itself. Tesla Insurance. It was pitched as the ultimate solution. Fairer prices based on your actual driving, using the car's technology to your advantage. It was supposed to be the savior for every owner tired of being gouged by traditional carriers. But is it? Or is the reality of insuring with Tesla a whole different kind of nightmare, with its own set of hidden traps and terrifying secrets? The answer is far more complicated than you think. Let's pull back the curtain on Tesla Insurance. On the surface, it's the ultimate Silicon Valley solution to a legacy problem. The pitch is intoxicatingly simple. Why should your insurance premium be based on crude, outdated metrics like your age, your zip code, or your credit score? Those are just proxies for risk. A Tesla with its array of cameras and sensors doesn't need proxies. It knows. It knows exactly how you drive moment to moment. And with that data, it can offer you a premium based on one thing and one thing only: reality. Your actual real-world risk. This is the promise of telematics, and Tesla's version is called the safety score. It's a number from 0 to 100, calculated in real time. That is supposed to be the purest reflection of your skill and safety behind the wheel. The higher your score, the lower your premium. Feels like the ultimate meritocracy. A safe driver who gets a 98 pays less than a reckless driver who gets a 75, even if they live next door to each other and drive the exact same car. For the thousands of Tesla owners who consider themselves excellent drivers but are penalized by their zip code or because their teenager just got a license, this sounds like a revolution. Finally, a system that's fair. And when you first sign up, it often feels like one. People report their premiums being cut in half, literally overnight. We're talking about going from $400 a month with a traditional carrier to under $200 with Tesla. The savings can be staggering, enough to make a significant dent in your monthly car payment. You download the app, you see your initial quote, and you feel like you've discovered the ultimate life hack. You feel smart. You feel like you've beaten the system. For the first few weeks, you drive with a sense of liberation. You're not just driving a technologically advanced car. You're part of a technologically advanced insurance system that finally rewards you for being the good driver you always knew you were. But then it happens. A tiny, almost imperceptible shift. You're driving down the highway, minding your own business, keeping a safe distance. A car 2 lanes over decides to cut across traffic and slice into the gap in front of you. You don't even have to touch the brakes. You just instinctively ease off the accelerator. But the car's computer, in its infinite wisdom, decides this was a close call. You get a jarring audible alert and a flash on the screen. Forward collision warning. Your heart sinks. You know what that means. You pull over later, open the app, and there it is. Your perfect 100 safety score has dropped to a 99. Feels personal. Unfair. You did nothing wrong. You were the victim of someone else's bad driving, yet you were the one who was penalized. Welcome to the tyranny of the algorithm. This is the first crack in the utopian facade of Tesla Insurance. The system is built on 5 key metrics: forward collision warnings per 1,000 miles, hard braking, aggressive turning, unsafe following distance, and forced autopilot disengagement. And what you quickly learn is that the computer judging you is a harsh, unforgiving master with absolutely no understanding of context. That forward collision warning? It will become the bane of your existence. It can be triggered by a car legally turning in front of you, by cresting a hill where the sensors momentarily think the road is an obstacle, by a blowing plastic bag, or even by a dark shadow on a sunny day. Each one is a demerit, a black mark on your permanent record. You start to dread that sound, tensing up every time you drive under an overpass. Then there's hard braking. This is perhaps the most perverse and dangerous flaw in the entire system. Imagine a child runs out into the street chasing a ball. A deer leaps onto the road. The car in front of you, for no reason, slams on its brakes. Your human instinct, your legal and moral obligation, is to brake as hard as you possibly can to avoid a collision. You do the right thing. You save a life, prevent an accident, and avoid thousands in damages. And how does Tesla Insurance reward you for this heroic defensive driving? Penalizes you. It flags the event as heartbreaking and lowers your score. The system, in its cold algorithmic logic, has just punished you for being a safe driver. This creates a terrifying psychological distortion. Owners in online forums talk about it all the time. They call it the Tesla tap. It's the moment where you have to make a split-second calculation. Do I slam on the brakes to avoid this minor fender bender and tank my safety score for the month, potentially costing me hundreds of dollars? Or do I just let it happen? Do I just tap the car in front of me, knowing the repair costs might actually be less than the insurance hike from the hard braking I'd need to avoid it? The very system designed to promote safety is now creating a perverse incentive to engage in unsafe, and frankly insane behavior. Changes you. The joy of driving your Tesla evaporates, replaced by a low-grade, constant anxiety. You're no longer just driving. You're performing for an invisible judge. You accelerate at a glacial pace to avoid any possibility of aggressive turning. You leave enormous, frustratingly large gaps in front of you, inviting other cars to constantly cut you off, which in turn risks triggering a forward collision warning. You become the slow, timid driver that everyone else on the road hates. Your fun_insanely_quick performance vehicle is now driven like a golf cart, all in service of appeasing the algorithm in your dashboard. You check your score on the app obsessively, your mood for the day dictated by a single number. The car that was supposed to be a symbol of freedom has become a digital prison. And here's another secret. This prison doesn't even exist in the same way for everyone. Tesla Insurance is a patchwork quilt of different rules and regulations, a geographical lottery that most owners don't understand until it's too late. It's only available in about a dozen states to begin with, but even where it is available, the rules are a mess. In a state like Texas, your premium is adjusted in real time based on your score. In a highly regulated state like California, they can use your score to set your initial rate, but they can't legally change it month to month based on your driving. In other states, certain metrics are weighted differently, so the advice you get from an owner in Arizona might be completely useless or even harmful if you live in Ohio. You think you're signing up for one product, but depending on your state's insurance commissioner, you could be getting something entirely different. The dream of a perfectly fair, data-driven insurance policy has morphed into a waking nightmare of constant anxiety, nonsensical penalties, and a system that punishes you for being a responsible, defensive driver. You're trapped paying a premium to a company that uses its own flawed, opaque technology to judge your every move on the road. You saved money, yes, but at what cost to your peace of mind? But all of this, the anxiety, the flawed scores, the psychological games, it's all just about what happens during your daily drive. It's about the bill you pay every month. It doesn't even begin to touch on the single most important question you can ask about any insurance company. What happens when you actually need them? What happens when the worst occurs and you get into a real accident? What is it like to file a claim with Tesla? Because if you think the algorithm that judges your braking is maddening, you have no idea what's waiting for you when you have to deal with their claims department. That is a journey into a whole new level of corporate hell. A labyrinth of ghosting, delays, and catastrophic repair bills that makes a bad safety score feel like a walk in the park. So let's walk through that labyrinth together. Picture this. You're driving your Model 3 home, minding your own business when someone, distracted by their phone, rolls into your rear bumper at a stoplight. It's not a huge crash. No airbags deployed, no screeching metal. Just a sickening crunch. The other driver is apologetic, insurance details are exchanged, and you think, okay, this is an inconvenience, but that's what I pay my premium for. You get home, you pull up your insurance app, you file the claim, and you feel a sense of relief. The system is working. That feeling lasts for about 12 hours. The next morning, you get a call from an adjuster. Let's call him Gary. Gary sounds friendly enough. He says, no problem, we'll get this sorted out. We have a network of preferred shops. Just take it to any of these 3 on the list I'm sending you, and they'll handle everything. You look at the list. You call the first shop. The conversation goes something like this. Hi, I was in a minor accident and need to get my Tesla Model 3 repaired. There's a pause on the other end of the line. A Tesla? Oh, no. We don't touch those. Sorry. Click. You call the second shop. Tesla? You need a certified shop for that. The equipment costs a fortune. We can't help you. Click. The third shop doesn't even pick up. Suddenly, that neatly paved road to recovery has turned into a dirt track with a giant chasm in the middle. You call Gary the adjuster back. None of your preferred shops will work on my car. Gary sounds confused. Well, that's strange. Are you sure? They're on our list. You explain patiently that Teslas aren't like other cars. They require specific training, specific tools, and a certification from Tesla to even order the parts. Without it, a body shop is just a building with wrenches. Gary says, okay, well, find a shop that will work on it, get an estimate and send it to us. The search begins. You find that the nearest Tesla-certified body shop is an hour and a half away. And when you call them, they tell you they are so backed up, the soonest they can even look at your car to write an estimate is in 9 weeks. 9 weeks? Just to get a quote. Your car is drivable, thankfully. But that rear bumper is a constant, ugly reminder of the bureaucratic nightmare you've just stepped into. You have no choice, so you book the appointment. 9 weeks later, you drop off your car. A few days after that, the estimate lands in your inbox. You open the PDF, expecting to see a number around $3,000 or $4,000. It's a plastic bumper cover, right? How much could it be? The number you see makes your stomach drop. $17,452. For a low-speed bumper tap. This isn't a typo. This is the reality of Tesla repair. And this is the moment the real fight with your insurance company begins. Because Gary the adjuster, who is used to approving $1,500 bumper jobs on Toyota Camrys all day long, sees this number and his brain short-circuits. He sees it as fraud. You see it as the cost of owning the car you love. So why? Why is it $17,000? Let's break it down. That bumper isn't just a piece of plastic. It's a sophisticated shell for a network of technology. Embedded within it are multiple ultrasonic sensors for autopilot and parking assist. The estimate lists each one at $300 a pop, plus the labor to install and wire them. The main wiring harness that connects them all was damaged. That's another $800. The foam absorber behind the bumper, a critical safety component, has to be replaced, that's $500. The bumper cover itself, unpainted, is over $1,000. But the real kicker, the part that insurance adjusters from the old world simply cannot comprehend, is the line item for sensor calibration. After those new sensors are installed, The car's entire autopilot and safety system suite has to be recalibrated. This isn't something you can do with a laptop in the parking lot. It requires a perfectly level surface, specialized optical targeting boards placed at precise distances and heights, and hours of work by a technician trained to do it. If the calibration is off by a single millimeter, it could cause the car to misjudge distances, phantom brake, or fail to detect an obstacle in a critical moment. That calibration procedure alone is $3,000 on your estimate. You forward this detailed 17-page estimate to Gary. His response comes back within an hour. This is outrageous. We're not paying this. My system estimates this repair should be $4,000 max. We'll pay for the bumper cover, paint, and 3 hours of labor. You're now caught in a triangle of misery. On one side, you have the certified body shop, the only people qualified to fix your car, who are legally and ethically bound to follow Tesla's official repair procedures to the letter. They can't skip the calibration. They can't use a non-OEM sensor. Doing so would make them liable if the car's safety systems failed later. On the other side, you have Gary and the insurance company operating from an outdated playbook. Their software, their training, their entire business model is built on the economics of traditional combustion engine cars. Their system sees replace rear bumper, and it spits out a number based on a Honda Accord. It doesn't have a field for a $3,000 sensor calibration. It doesn't understand that the labor rate is higher because the technician had to go through weeks of specialized training to work with high-voltage systems. Gary's job isn't to get your car repaired correctly. His job is to minimize the insurance company's payout. He's looking at the $17,000 estimate not as a necessary cost, but as a $13,000 failure on his part. And you're stuck in the middle, a hostage in a war between the future of automotive technology and the past of the insurance industry. But it gets worse. While you're arguing with Gary, sending him technical bulletins from Tesla and having the body shop manager plead your case, your car is just sitting. And the body shop gives you more bad news. Even if the insurance company approves this today, they say, we have to order the parts. That specific wiring harness and 2 of the sensors are on national backorder from Tesla. The ETA is 4 to 6 months. 4 to 6 months. This is the other dirty secret of Tesla ownership. While their vertical integration is brilliant for manufacturing, their parts and service logistics can be a black hole. There is no massive, independent aftermarket for Tesla parts like there is for Ford or GM. You can't just buy a third-party sensor. You have to get it from Tesla, and if they don't have it, you wait. Now, think about your rental car coverage. Most standard policies, even the good ones, have a limit. It's usually 30 days or maybe a maximum payout of $1,500. That runs out fast when you're waiting 6 months for a part. So while your $70,000 car sits collecting dust, you're now paying for a rental out of pocket, on top of your monthly Tesla payment, on top of your insurance premium. The financial bleed is immense. Gary, of course, offers no sympathy. Parts delays aren't our responsibility, he says, reading from a script. We've approved what we consider to be a fair and reasonable amount for the repair. The rest is between you and the shop. You're abandoned. The company you faithfully paid every month to protect you from this exact scenario has just slammed the door in your face. They've cashed your checks and are now questioning the very nature of the car they agreed to insure. You bought the car of the future, but you're trapped in an insurance system from the past. And the worst part? Your story isn't the exception. It's becoming the rule. Now, what happens when the damage isn't just a bumper but something far, far worse? Let's talk about the automotive equivalent of a paper cut that requires a full-body cast. Imagine you're driving your Model Y on the interstate. You're cruising, autopilot engaged, feeling like you're living in 2035. Suddenly, a chunk of debris from a truck ahead of you tumbles across the lane. You don't have time to swerve. You hear a loud, sickening thud from underneath the car. You pull over, heart pounding. You get out, look around the car. Nothing. No dents, no major scratches. You even get on your hands and knees and look underneath. You see a scrape, maybe a small dent on the big metal plate that protects the battery. The car drives perfectly fine. No warnings on the screen. You breathe a sigh of relief, thinking you dodged a bullet. You decide to be a responsible owner and take it to a Tesla-certified shop just to be safe. You file an insurance claim, expecting a simple $1,000 repair for a dented skid plate. A week later, you get a call. But it's not from the repair shop. It's from your insurance adjuster. And the first words you hear are, "We're sorry, but your vehicle is a total loss." You're stunned. You think there must be a mistake. A total loss? The car drives fine. It's a scratch. But the adjuster is firm. The estimate to repair that scratch isn't $1,000. It's $22,000. Your 2-year-old Model Y is worth maybe $40,000. And just like that, the insurance company's cold, hard algorithm kicks in. The repair cost has breached the total loss threshold. Your car is, in the eyes of the system, dead. Welcome to the single biggest, most misunderstood, and financially terrifying issue facing Tesla owners today: the structural battery pack. To understand why a simple rock can write off a $50,000 car, you have to understand what makes a Tesla a Tesla. In most cars, the battery is just a component. It's a heavy box that gets bolted into the chassis. But starting with the Model Y and the new Model 3s built in Texas, Tesla did something revolutionary. They made the battery pack part of the car's skeleton. The cells aren't just sitting in a box. The box is the floor, the structural core of the vehicle. The front and rear seats bolt directly onto it. This design is brilliant for manufacturing efficiency, for creating a low center of gravity, and for making the car incredibly rigid and safe in a crash. It is an engineering marvel, but it is an insurance nightmare. Because for the longest time, and in many cases still, Tesla's official position has been absolute. If the structural pack is breached, dented, or damaged in any way, it cannot be repaired. It can only be replaced. There is no middle ground. There is no patching the case. There is no swapping out a few damaged cells. The entire multi-ton high-voltage heart of the car must be ripped out and a brand new one installed. And that procedure, as you just heard, costs upwards of $20,000. Think about what this means from your insurance company's perspective. They are not car people. They are risk and data people. An adjuster who is used to looking at bent frames and crumpled fenders now has to assess a scratch on a battery. They have no idea what's happening inside that sealed metal box. Is it just a cosmetic dent? Or have the delicate lithium-ion cells inside been compromised, creating a ticking time bomb for a potential fire weeks or months down the road? They don't have the tools to find out. They don't have the training. And Tesla isn't giving them a way to check. So what do? They look at the official Tesla repair manual, which gives them one single, terrifying option: full replacement. They run the numbers. A $20,000 part, plus thousands in specialized labor. The total quickly approaches 75% of the car's value. And for them, the decision is simple. It's a calculation. It is cheaper, safer, and legally smarter for them to just write you a check for the car's ACV, its actual cash value, and wash their hands of the problem entirely. They avoid the unknown risk of a faulty repair, they cap their financial exposure, and they move on. But you don't get to move on. You're left standing in the wreckage of their financial calculation. You get a check that, after your deductible, might not even be enough to pay off your car loan. If you didn't pay for gap insurance, you could literally be writing a check to your bank for a car that's already on its way to a salvage auction. Your dream of owning the future is now a financial hole. And you have to start all over again, shopping for a new car in a market with inflated prices and higher interest rates. All because of a rock on the highway. This is not a rare, one-in-a-million scenario. Reports from Reuters and countless stories on owner forums have highlighted this exact problem over and over again. Teslas with as little as 10,000 miles on them, with damage that looks purely cosmetic, being sent to the automotive graveyard. But here's where the story gets truly insane. What happens to these totaled cars? They're sold at auction for pennies on the dollar to salvage yards and, more importantly, to a growing subculture of incredibly talented, independent mechanics and YouTubers. These are the people who are willing to do what Tesla and the insurance companies will not: open the box. They buy your totaled Model Y for, say, $12,000. They put it on a lift in their garage. They painstakingly remove the battery pack, a process that involves basically disassembling the entire car interior. They take the cover off the pack, and what do they often find? A dented casing and maybe a handful of damaged cells in one corner of the pack. The other 99% of the battery is perfectly fine. They don't replace the whole thing. They perform surgery. They have the knowledge and the tools to safely de-energize the pack, cut out the damaged sections, replace individual cells, and weld the casing back together. They test it, they reinstall it, and boom, the car is back on the road, perfectly functional. Their total cost for the repair? Maybe $2,000 or $3,000 in parts and a lot of skilled labor. They then sell the car with a salvage title for a handsome profit. Let that sink in. The same damage that your insurance company declared a total loss, forcing you into a financial crisis, was fixed by someone in their garage for less than the cost of a new set of tires. This reveals a Grand Canyon-sized disconnect in the entire system. On one side, you have the official world of Tesla and its certified network, bound by rigid, risk-averse policies that favor full replacement. On the other side, you have the insurance industry, which is terrified of the unknown liability and defaults to the most expensive, yet predictable, option. And in the middle is you, the owner, paying the ultimate price for their mutual inflexibility. Every time an insurance company pays out a $40,000 claim for a reparable car, it's not free money. That loss gets fed back into their data models, and the result is that premiums for every single Tesla owner in your state go up. It's a vicious cycle of waste. Perfectly good cars are being scrapped, owners are being financially ruined, and a gray market of repair artists is thriving in the shadows, proving every single day that there is a better way. It forces you to ask a very uncomfortable question. Is this systemic failure an accident? Or is this extreme control over the repair process, this black box that no one is allowed to look inside, part of a much bigger, more deliberate strategy from Tesla itself? To answer that, we have to stop thinking about Tesla as just a car company. That's the key. For GM, Toyota, they are car companies. They design a vehicle, they build it, and they sell it to you. Their business model, for the most part, ends right there. Sure, they have financing arms and service centers, but their core identity is manufacturing. Tesla is different. Tesla is a technology company that happens to make cars. And like all great tech companies of our era, Apple, Google, Amazon, their goal isn't just to sell you a product. Their goal is to build an ecosystem. A walled garden. Think about Apple. You buy an iPhone. Suddenly, it just makes sense to get an Apple Watch. And then AirPods. Your photos are in iCloud, you listen to Apple Music, you buy apps from the App Store where Apple takes a 30% cut of everything. It all works together so seamlessly, so beautifully, that leaving the ecosystem becomes incredibly difficult and inconvenient. It's not a trap. It's a velvet-lined cage with Wi-Fi and a great user interface. Now look at Tesla. You buy the car. You use their proprietary supercharger network. You buy software upgrades like full self-driving directly from the car's screen. You might even have their solar panels and Powerwall at home. Every piece is designed to integrate perfectly with the others. So what's the last massive recurring revenue piece of the car ownership puzzle that Tesla can pull inside its walls? Insurance. And the multi-billion-dollar repair industry that supports it. This isn't a conspiracy theory. It's a well-established business strategy called vertical integration. And when you look at the repair process through this lens, everything starts to make a terrifying amount of sense. The extreme control is not a bug. It's a feature. Let's start with the most valuable commodity in the 21st century. Data. Your Tesla is a rolling supercomputer generating an astronomical amount of data every single second. It knows how fast you accelerate, how hard you brake, how sharply you turn, what time of day you drive, where you drive, whether you were using autopilot, and 1,000 other variables. When you get into an accident, Tesla doesn't just know that you crashed. They can often know the precise sequence of events leading up to it, down to the millisecond. Now, who else wants that data? Every insurance company on the planet. For traditional insurers, a car is a black box. They have to rely on broad, crude statistical models. They know your age, your zip code, your driving record, and the type of car you have. From that, they guess how risky you are. It's like trying to perform surgery with a butter knife. Tesla, on the other hand, has a surgical laser. They have the real-world granular data on how their vehicles and their drivers perform. They don't have to guess. They know. This data is the secret sauce for Tesla Insurance. It allows them to price risk with a level of accuracy that competitors can only dream of. So here's the strategic masterstroke. By making the repair process a closed loop, they protect their data advantage. If any independent mechanic could plug into your car, diagnose it, and repair it, that data stream would become leaky. Other companies could start to analyze parts, understand failure rates, and reverse engineer Tesla's technology. The data is a competitive moat, and the difficult repair process is the wall that defends it. They are not just controlling the parts, they are controlling the information. By forcing nearly every damaged Tesla back into their approved network, they get a front-row seat to every failure, every fender bender, every major collision. This creates an unparalleled feedback loop. They learn exactly how their cars fail in the real world, which they can use to make future cars safer and cheaper to build. And most importantly, they use it to refine their insurance pricing model, making it more and more unbeatable over time. But data is only half of the equation. The other half is cold, hard cash. The auto repair industry in the United States is worth over $200 billion a year. Let me say that again. $200 billion. Traditionally, automakers see almost none of that. That money goes to a vast network of independent body shops, national chains like Caliber and Gerber, and third-party parts suppliers. Tesla looks at that $200 billion pie and asks a very simple question. Why aren't we getting a slice of that? Why are we letting all this value leak out of our ecosystem? By restricting access to parts, by requiring proprietary software for calibrations, and by tightly controlling the certification of body shops, Tesla isn't just ensuring quality control. They are systematically dismantling the competitive landscape. They are creating a system where, for many repairs, they are the only game in town. They become the manufacturer, the parts distributor, the repair facility, and the insurer. They control the entire value chain, from the moment the car is built to the moment it's repaired after a crash. Think about it from a business perspective. If you're Tesla Insurance and you have to pay out a claim, where does that money go? In a normal scenario, it goes to an independent shop. But in Tesla's world, there's a good chance that money flows from one of Tesla's pockets, the insurance arm, right into another of Tesla's pockets, the service and parts division. It's a brilliant, self-sustaining financial loop. They're not just insuring a car. They're ensuring access to their own closed, high-margin repair network. Now, Tesla's official argument, their defense for all of this, is a very reasonable one: safety and quality. They will tell you that these cars are so technologically advanced, with complex battery systems and advanced driver assistance sensors, that only a technician trained by Tesla, using genuine Tesla parts and proprietary software, can guarantee the vehicle is returned to its pre-accident state of safety. And honestly, there is a lot of truth to that. You don't want an untrained mechanic messing with a high-voltage battery pack or misaligning a radar sensor that controls your emergency braking. But critics, including many in the right to repair movement, would call this a convenient excuse. They argue that it's possible to provide independent shops with the training, tools, and information needed to perform safe repairs, but that Tesla is deliberately withholding them to maintain their monopoly. It's a classic case of a valid concern, safety, being used to justify a highly profitable, anti-competitive business practice. They've created a problem, a car that's incredibly complex to fix, and then sold themselves as the only solution. So, is it a deliberate strategy? When you look at the evidence, it's hard to argue otherwise. The control over repairs creates a data monopoly that powers their insurance product. That same control funnels a massive portion of the multi-billion-dollar repair industry directly back into their own coffers. And it's all done under the very defensible banner of safety and quality. It is a three-dimensional strategy, a masterclass in building a technological ecosystem. For the Tesla owner, it means you've bought more than a car. You've bought a ticket into a new kind of world, a world of incredible innovation, but also of unprecedented control. And at the very heart of this system, the mechanism that ties it all together, is the very tool they use to decide your insurance premium. It's called the Tesla Safety Score. And this score, the simple number from 1 to 100, is the key that unlocks the true nature of Tesla's grand vision. But what if the tool designed to prove you're a good driver is also the tool that locks you inside their world forever? This is the paradox of the golden handcuffs. Tesla Insurance isn't just a product. It's a piece of a much larger, more intricate machine. On the surface, it offers an incredible deal. Prove you're a safe driver, and we'll reward you with rates that traditional insurers simply cannot match. We're talking about potential savings of 30, 40, even 60%. For a high-performance electric vehicle, that's not just pocket change, that's thousands of dollars a year. Feels like a revolution. It feels like you're finally being judged on your actual driving, not on your age, your zip code, or the color of your car. And who wouldn't want that? The system is built on 5 pillars, the 5 commandments of Tesla's safety score. Forward collision warnings per 1,000 miles. Hard braking. Aggressive turning. Unsafe following distance. Enforced autopilot disengagement. Each event dings your score. Fewer dings mean a higher score. A higher score means a lower premium. It's elegantly simple. But the simplicity is deceptive. Because when you look closer, when you live with this system day in and day out, you start to see the cracks in the foundation. You start to realize you're not just playing a game. You are being shaped by it. Let's start with the most notorious of them all. Forward collision warnings. In theory, this is a lifesaver. The car's advanced sensors detect an imminent crash and warn you. If you get a lot of these warnings, you're probably a reckless driver, right? But ask any longtime Tesla owner about phantom braking. You're driving down a perfectly clear highway. Blue sky, open road. Suddenly, the car slams on the brakes and screams a collision warning because it thought a shadow from an overpass was a stalled truck. Or it mistakes a plastic bag blowing across the road for a pedestrian. You, the driver, did absolutely nothing wrong. In fact, you were paying perfect attention. But the car's own glitch, its own phantom perception, has just been recorded as a black mark against your record. Your score drops. Your premium is at risk. You've just been penalized by an algorithm for a mistake the algorithm itself made. Imagine you're a driver we'll call Mark. Mark is meticulous. He loves his Model 3. He treats the safety score like a video game he's determined to win. He keeps his following distance perfect. He accelerates like he's chauffeuring a queen. He takes corners with the gentleness of a flowing river. He's got a 99. Then, one Tuesday morning on his commute, a phantom collision warning. Bam! His score drops to a 97. He's furious, but there's no one to call. There's no appeals process. You can't debate a server rack in Palo Alto. The judgment is instant and it is final. He spends the rest of the month driving with a knot in his stomach, terrified of another digital ghost appearing on the road. This isn't driving for safety anymore. It's driving in fear of the machine that's supposed to be keeping you safe. Then there's heartbreaking. Again, sounds reasonable. People who slam on their brakes are aggressive, right? But what about the driver who cuts you off in traffic? What about the child who chases a ball into the street? In those moments, heartbreaking isn't aggressive driving. It's defensive driving. It's life-saving driving. But the system has no context. It doesn't see the reckless teenager who swerved into your lane. It doesn't see the deer that just leaped from the woods. All it registers is a rapid change in velocity. It sees a data point that violates a preset threshold. And so, the very act of avoiding an accident caused by someone else can lower your score and increase your insurance premium. You are punished for being the responsible one. Aggressive turning is just as flawed. The car's accelerometer measures G-forces. Exceed a certain limit and you get a demerit. But what is aggressive? Taking an on-ramp at the posted speed limit? Swerving to avoid a massive pothole that could destroy your 21-inch upper turbine wheels? The system doesn't differentiate between a reckless street racer and a conscientious owner trying to protect their vehicle. It's a blunt instrument in a world that requires surgical precision. An unsafe following distance is perhaps the most disconnected from reality. Tesla measures the time in seconds between you and the car in front. It wants you to maintain a large, safe bubble. That's a noble goal on an open interstate in Wyoming. But try driving like that in Los Angeles, Chicago, or New York City. If you leave a 3-second gap in rush hour traffic, you haven't created a safety bubble. You've created a parking spot. 3 other cars will cut in front of you before you can even blink. To survive in urban traffic, you are forced to drive in a way that the safety score deems unsafe. The system penalizes you for adapting to the real-world environment it operates in. You see the pattern here? The safety score doesn't actually measure how safe you are. It measures how well you comply with a rigid, context-blind, and sometimes faulty algorithmic ideal of a perfect driver. A driver that doesn't exist in the messy, unpredictable real world. But here is where the golden handcuffs truly begin to tighten. Let's say you master the game. You learn the system's quirks. You tolerate the phantom warnings. You drive in a way that pleases the algorithm, and you are rewarded with a 98 score and an insurance premium that is half of what Geico or Progressive quoted you. You are saving a fortune. You're happy. Then after 3 years, a new car catches your eye. Maybe it's a Rivian R1S for the family. Maybe it's a Porsche Taycan. You decide it's time for a change. You go to get an insurance quote for your new non-Tesla vehicle. And you are hit with a tidal wave of sticker shock. Your rates have doubled, tripled. Why? Because that beautiful, hard-earned safety score of 98 is worthless outside of Tesla's walls. It's a currency that is only accepted in one store. You can't take your Tesla driving data and show it to another insurance company. There is no standard, no data portability. Your proven record of safe, algorithm-pleasing driving history evaporates the second you sell your Tesla. All of that careful driving, all of that anxiety about your score was for nothing. You're thrown back into the general pool of drivers, and your premium is once again based on those old metrics: your age, your zip code, your credit score. This is the lock-in. Tesla has created a system where leaving the brand comes with a significant and immediate financial penalty. The low insurance rate that felt like a reward now feels like a tether, keeping you anchored to their ecosystem. The longer you stay, the more you save, and the more painful it becomes to leave. The golden cage gets more comfortable every year. You've traded choice and freedom for a discount, controlled by a system you can't question, can't appeal, and can't take with you. This isn't just about one car company's insurance product. This is a glimpse into a new kind of future. A future where our behavior is constantly monitored, scored, and monetized by the very products we own. But what happens when this model escapes the car and begins to permeate every other aspect of our lives? What happens when it's not just your car, but your home, your health, your entire life being scored by a corporate algorithm? The question is no longer hypothetical. The answer is, it's already happening. The Tesla safety score isn't a radical new invention. It's the canary in the coal mine. It's the most visible, most talked about example of a massive silent shift that is fundamentally reshaping the bedrock of our financial lives. We're moving from a system of pooled risk, where we all pay into a system to protect each other, to a world of radical personalization, where every single action you take is weighed, measured, and used to calculate your individual hyper-specific price of admission to modern life. Let's start with health insurance. For years, they've used broad categories: smoker or non-smoker, age, pre-existing conditions. But now that's ancient history. Companies like John Hancock have their Vitality program, which directly links your life and health insurance premiums to data from your Fitbit or Apple Watch. Walk 10,000 steps a day, get a discount. Meditate with a partner app, your premium might drop. On the surface, it sounds great. A win-win. You get healthier, they take on less risk. But what about the other side of that coin? What if you have a medical condition that prevents you from being active? What if you work 2 jobs and are simply too exhausted to hit the gym? What if you just don't want to share your personal health data with a multi-billion-dollar corporation? Suddenly, your choice to maintain your privacy or your inability to meet an arbitrary fitness goal is financially penalized. Your insurance costs more, not because you're a proven risk, but because you refuse to participate in the 24/7 surveillance of your own body. The algorithm doesn't care about your context. It only cares about the data points you feed it, or the ones you don't. Now let's walk into your home. The same principle is at play. Insurers are offering significant discounts if you install smart home devices. A Ring doorbell, a Nest thermostat, smart smoke detectors, water leak sensors. Again, it sounds logical. A connected smoke detector that alerts the fire department automatically is better than one that just beeps while you're on vacation. A sensor that detects a leak before it floods your basement saves everyone money. But think about what you're trading for that discount. You are giving an insurance company a live, real-time data feed from inside the walls of your most private space. They might know when you're home and when you're away. They might know what temperature you keep your house at, which could, in their actuarial tables, correlate to the risk of pipes bursting. What happens if you go on vacation and forget to set your smart alarm? Is your claim for a break-in denied because of negligence proven by your own data? What if your smart detector's battery dies and you don't replace it for 48 hours? Does a flag go up on your account? Your premium for next year just ticked up a few percentage points. You've essentially installed a corporate supervisor in your own home, and its job is to watch you and to score you constantly. But it gets even more personal. Let's talk about life insurance. This is the ultimate actuarial game. A financial bet on your mortality. For a century, the process was straightforward. A medical exam, a blood test, and a questionnaire about your lifestyle. Do you skydive? Do you smoke? That was the depth of it. Today, a growing number of insurers are pioneering what they call fluidless, or accelerated underwriting. It means they can give you a quote in minutes without a single needle. How? By creating a digital ghost of you, assembled from thousands of scattered data points you leave behind every single day. They pull your credit report, your prescription history, your motor vehicle records. But they also go deeper. They partner with data brokers who analyze your online shopping habits. Are you buying plus-size clothing? Or organic kale and a Peloton? They can analyze your social media posts for sentiment. Are you expressing signs of depression? Or are you posting happy vacation photos? Every click, every purchase, every public post becomes a proxy for your health and your risk-taking behavior. You are being judged on a version of you that you didn't even know existed, built by a silent algorithm in a server farm hundreds of miles away. And you have no idea what data points are being used, how they're being weighted, or if the data is even accurate. What we are witnessing is the birth of a privatized, corporate-run social credit system. In the US, it isn't the government assigning you a score that determines if you can buy a plane ticket. It's a dozen different companies, all building their own secret, proprietary scores that determine if you can afford to drive a car, own a home, or get life-saving medical care. The Tesla safety score is just the beginning. Soon you'll have a health score, a homeowner score, a parental score, a consumer score. Each one is a black box. You can't see the formula. You can't appeal the decision. When your premium inexplicably doubles, the customer service agent won't be able to tell you why. They'll just say, "That's what the system decided." The system, an impartial, unfeeling god of data that dictates the cost of your existence. And this creates a terrifying new form of inequality. It's a divide between the data-rich and the data-poor. People who understand this game, who have the time and resources to optimize their lives for the algorithm, they will thrive. They'll get the best rates, the best service. But what about everyone else? The person working an overnight shift whose driving is flagged as risky by the Tesla algorithm? The single parent who orders takeout because they're too tired to cook and sees their health score dip? The elderly person who isn't tech-savvy enough to manage a suite of smart home devices? They become the underclass of this new data-driven world. They are penalized, charged more, and pushed to the margins, not because of any real risk they pose, but because their lives don't fit the neat, optimized pattern that the algorithm demands. And we haven't even touched on the single biggest point of failure in this entire techno-utopian vision: security. We are building a world where the most sensitive, intimate details of our lives are being collected, aggregated, and stored by dozens of different companies. Your driving habits, your heart rate, the video feed from your front door, your shopping history. Each one of those companies is a target for hackers. Every single day we hear about another massive data breach. What happens when your risk profile is stolen and sold on the dark web? What happens when a hacker gains access not just to your credit card number, but to your entire life score, and uses it to blackmail you, or to take out fraudulent policies in your name, destroying your financial reputation? We are building a vast, interconnected panopticon of personal data, and we are entrusting the keys to the lowest bidder on a cybersecurity contract. We are being sold a promise of fairness and personalization, a world where you only pay for what you use and the risk you represent. But what we are getting is a world of constant surveillance, opaque judgment, and crushing anxiety. A world where every decision, from taking a sharp turn to ordering a pizza, carries a hidden financial consequence. We're living in a world of invisible scorecards, judged by algorithms we can't see, in a game whose rules we're not allowed to know. The game seems rigged, but what if there was a way to play it on our own terms? What if you could flip the script on the algorithms and take back control? The secret isn't a cheat code. It's a playbook. It's understanding that the insurance industry, for all its complexity and algorithmic smoke and mirrors, is still a business. And like any business, it responds to savvy, informed customers. Taking back control doesn't mean hacking their servers. It means re-engineering your own approach. It means transforming yourself from a passive ratepayer into an active, strategic manager of your own risk. Over the past 9 parts, we've journeyed deep into the belly of this beast. We've seen how the very things that make a Tesla a marvel of engineering, its aluminum unibody, its integrated battery pack, its advanced sensor suite, also make it a nightmare for traditional repair shops and a puzzle for actuaries. We've pulled back the curtain on Tesla insurance, revealing both its revolutionary potential and its frustrating pitfalls, a system that promises fairness through data, but sometimes delivers anxiety through opacity. We've untangled the web of telematics, stared into the black box of the safety score, and realized that our every turn, every acceleration, every late-night drive can be converted into a data point that works either for us or against us. We've navigated the chaotic landscape of carriers, some welcoming Teslas with open arms, others slapping them with astronomical premiums, treating them like exotic supercars. It's a complex, often maddening world, but knowledge neutralizes complexity, and that knowledge is the foundation of our playbook. This isn't a list of tips. It's a new operating system for how you manage your insurance. First, the annual insurance audit. You must treat your insurance policy not as a bill you pay, but as a contract you renegotiate. The single biggest mistake any car owner, especially a Tesla owner, can make is set it and forget it. Loyalty in the world of insurance is often a liability, not an asset. Insurers are notorious for a practice called price optimization, a sanitized term for slowly creeping up the rates on loyal customers who are unlikely to shop around. They bank on your inertia. Your job is to break that inertia. Every single year, at least 1 month before your policy renews, you must go back to the market. Get quotes. All of them. From the big legacy players to the new insurtech startups. Use online comparison tools, but don't stop there. This annual ritual does two things. It ensures you're always paying a competitive rate, and it forces you to reevaluate if your current coverage still fits your life. Maybe you're driving less. Maybe your financial situation has changed. Your policy should be a living document, not a dusty file. Second, master your data. We've spent so much time talking about how insurers use your data against you. Now let's talk about how you use it for you. This is a conscious choice. If you opt into a usage-based program like Tesla Insurance or others, you are no longer just a driver, you are a data generator. So be a professional one. Understand the metrics that matter. If the system penalizes hard braking, practice smoother deceleration. If it dings you for late-night driving and you have the flexibility, adjust your schedule. This isn't about letting an app control your life. It's about understanding the rules of a game you've chosen to play, and then winning it. But the ultimate move in mastering your data is knowing when not to share it. If you value your privacy, or if your driving style simply doesn't align with the algorithm's definition of safe, your power lies in choosing an insurer that doesn't require telematics. The control is in the choice. You can choose to play the data game, or you can choose a different game entirely. Third, and this might be the most powerful tactic in the entire playbook, leverage an independent agent. We're conditioned to think we can get the best deal by going directly to the source. But the insurance market is an exception. An independent agent or broker doesn't work for one specific insurance company. They work for you. They are your professional shopper. A good independent agent who understands the EV market is worth their weight in gold. They have access to dozens of carriers, including specialty insurers you've never heard of. They understand the esoteric endorsements you might need, like specific coverage for your wall charger, or ensuring OEM parts are used in repairs. They can take your specific driver profile, your car's VIN, your location, and shop it across a vast network, finding the hidden gems and avoiding the landmines. They translate the jargon, negotiate on your behalf, and do the legwork. Going it alone is like walking into a legal battle without a lawyer. Why would you? Fourth, deconstruct your coverage. Stop looking at the final price tag and start looking at the architecture of your policy. The premium is the outcome, not the product. The product is protection. So what are you actually buying? Look at your liability limits. The state minimums are a joke. In a serious accident, they'll be exhausted in seconds, leaving your personal assets exposed. For a car like a Tesla, you should be looking at significantly higher limits, 100,000, 300,000, even more, often bundled with an umbrella policy. Then look at your deductibles. A higher deductible on collision and comprehensive will lower your premium. But can you comfortably pay that amount out of pocket tomorrow? It's a personal risk calculation. Most importantly, scrutinize the endorsements. Do you have new car replacement? Gap insurance? Rental reimbursement with a high enough daily limit to cover a comparable car? Not a compact sedan? And the holy grail for Tesla owners, an OEM parts endorsement. This guarantees that if your car is repaired, it will be with genuine Tesla parts, not cheaper aftermarket alternatives. Building the right policy is like tailoring a suit of armor. You don't buy it off the rack. You have it custom fitted to protect your specific weak points. And finally, the fifth rule of the playbook: document everything. From the day you take delivery, you are the curator of your car's story. Take detailed, high-resolution photos of your Tesla from every angle, inside and out, every few months. Keep a meticulous digital folder with every service record, every software update notification, every receipt for accessories. Why? Because in the event of a claim, especially a total loss, the insurance company's first offer will be based on a generic valuation. Your documentation is your evidence. It's your proof of the vehicle's pristine condition, its specific options, its history of care. It is your single most powerful tool to dispute a lowball offer. You are building a case for your car's true value before you ever need to. This playbook isn't just about saving a few $100s. It's about a fundamental mindset shift. You are not a victim of the insurance system. You are the CEO of your personal risk management. Your Tesla is a significant financial asset, and this is how you protect it intelligently. The future of this space is only going to get more complex. AI will process claims in seconds, new forms of data will be collected, and the very definition of risk will change with every step we take toward full self-driving. Staying ahead of that curve isn't optional. It's essential. And this is where this journey becomes a conversation. We've built the foundation, but the real-world knowledge lives within this community. It lives with you. So, I want you to do something. Down in the comments, share your story. What's the single best piece of insurance advice you've ever received? What's the craziest, most outrageous quote you've ever been given for your Tesla? Which insurance company has been a dream to work with, and which one has been a nightmare? Let's turn this comment section into the single greatest, crowdsourced resource for Tesla insurance on the internet. Your experience could be the key that saves a fellow owner thousands of dollars and a massive headache. If this series has opened your eyes, if it has given you a new sense of control, if it has armed you with the knowledge to better protect yourself and your investment, then our mission has been a success. This conversation, this education, it doesn't end here. The world of technology, finance, and electric vehicles is in constant, rapid evolution, and we will be here to decipher it all every step of the way. To make sure you're always ahead of the curve, hit that subscribe button and ring the notification bell. You bought a car from the future. It's time your insurance strategy caught up. Drive smart, stay informed, and never settle.